Before we get started or I dive into my formal remarks, I thought it would be appropriate for me to share just a couple things with you about our firm, Bernstein. So just a couple things. We are an investment research and asset management firm, a very, very pure play organization in that we do only those two things, research and manage money for high net worth taxable individuals, families, foundations, and institutions all around the world. And we do global research, which many of you probably are familiar with, and it's pretty highly regarded in that we are a completely independent firm, conflict-free. We don't do any banking business. We do no trust business. We do no other sorts of lending. We're not in the insurance business. So just consider us a very, very pure play asset management research firm. Currently today, after 45 years, we manage about $425 billion in assets. So a couple things before I dive into the comments as well. I'm told to apologize because I'm going to be talking very quickly, but I have to admit there's a lot going on in our world. So I've got a lot of things that I want to cover, but I'm going to do it in a short period of time. Happy to visit with you after the panel discussions this morning or at any other date to follow up in further detail. So I thought I'd start off with the three big questions that our clients ask us, although I heard them again this morning, and share with you our answers. First of all, first question these days is who's going to win the election? I've got to be clear, they're not saying what are the impact of that, which I might be able to help out with. They're asking who's going to win the election. Next question is what's my tax rate going to be in January? And the next one is the Houston Texans, are they going to be in the Super Bowl? My answers are I have no idea, and God, I hope so. So keep it very simple. Let me flip forward to what we do know a little bit more about, and that is the capital markets. It is very clear, we've all personally experienced this over the last 4 or 5 years, public markets have been extremely volatile. We are clearly in a 2 steps forward, 1 step back environment. But the good news is, literally, if you back up to January 1st of 2009 and go forward through August, the markets are up 50%. Now, if I fix my end point, start point a little bit, and I start March of 2009, which was the bottom of the public markets, and take you through yesterday, you're pushing 100% capital appreciation in the equity markets. It doesn't feel like it. It feels pretty miserable, and I can tell you most people are not in it. And we'll talk more about that in just a couple of minutes. But it's been very volatile, and even though the markets are up, there's no doubt that investors within those markets are completely focused on fear, and therefore focused on safety. I'll use utilities as an example on this slide on the left-hand side. In 2011, and this continues through today, the utility sector as a whole, year-over-year earnings contracted 12%. So utilities as a group, their earnings went down, yet on the right-hand side, as you can see, their price versus their earnings went up 30%. Their prices in general went up 17%, and the sector is contracting. That is an addiction to safety or perceived safety in the capital markets. Look on the lower left-hand portion of the slide. In energy, the opposite is true. Energy sector grew 37%, their earnings last year. Move to the right. Their price versus their earnings contracted 25%. People's investment time horizon is tomorrow morning. What can you do for me right now? And utilities have this perceived safety of stability. They're not going anywhere. They're highly regulated, and they'll pay me a dividend. And as a result, investors in the stock market, within the stock market, are obsessed with that and flocking to it, and I would say have potentially overpriced some of those sectors. So the good news is opportunity exists out there. The best example I can come up with safety or desire for safety is the United States 10-year Treasury bill. And I took this slide back to 1960 to give us a 50-plus year perspective of the cyclicality nature of interest rates. And as you can see, the 1.8 on the far right-hand side is at the bottom of the interest rate cycle. And we all know in this room that interest rates have been as low as 1.48% in the 10-year Treasury about 6 weeks ago. And this is an insatiable appetite around the planet for total perceived safety in purchasing treasuries and pushing interest rates down. The thing we know is that it's not if, it's when interest rates are going to start going up. It's going to happen at some point in time. It may be further out there, but there's not much more room for that particular sector to appreciate. The question we have to ask ourselves today is, are investors overreacting? And the answer is mixed. Probably. Individuals and even institutions tend to invest emotionally. But when you look at it from an economic perspective and look at GDPs around the world, you find an interesting story. So Japan, who was just literally put on their back with an earthquake and a tsunami a little over a year ago, rebounded quite nicely, and it looks like they're going to come in around 3% GDP this year. The emerging countries are growing at about 5%, which is much, much slower than they were growing, but they're growing double the rest of the world, and they are an engine in the world. U.S. at about 2.5%, a little bit lower than originally anticipated, but really when you sum it all up, the globe in GDP perspective is growing at 2.4%. Now that's not lighting anything on fire, but it's growing, slowly growing, and it's moving forward. Now clearly, people's focus these days has been on Europe, without a doubt. Busy chart, a lot going on over there, but let me sum it up. This is not something that's going to be solved quickly, period. There are many, many structural issues in the Eurozone. There are economic issues that they have to deal with. There are clearly political issues, and they're working through them. So the one thing I'd say here is it's going to take time. Unfortunately, we're going to have to just watch the sausage be made. These cultures typically watch the barn get burned down right beside them, and right before it's completely on the ground, they act. So we're likely to have to watch that. The good news is on that front is the actions that have been taken over the last 6 to 9 months likely have significantly reduced the odds of some sort of a spectacular Lehman-like meltdown. That was on the table, but the odds of that occurring at this point in time are low. They're not gone, but the odds of that occurring tomorrow morning or over a weekend when we happen to be dealing with a hurricane here are much, much lower. So that's the good news. But as much as Europe is the focus of everybody's attention, when we come back to the United States, the news is much better. Let's start off talking about the consumer for just a minute. The consumer in the United States is, from a debt obligation perspective, in better shape than they've been in 20 years. And what I mean by this is when they, on a monthly basis, they tally up how much I owe every single month, that obligation ratio has plummeted as a result of people, just like companies, delevering. They're paying off their credit card bills, they're paying off their car bills. They are reducing their mortgage payments because interest rates are so much lower, and unfortunately a big chunk of this doesn't make a lot of people in this room happy, but is people just not having a mortgage anymore. Somebody else taking care of that business, defaults, right? But the fact of the matter is people have more money in their pockets, individuals do, and that leaves them room to buy more diapers and to buy more tennis shoes and tires for their cars, and that is a good thing for the U.S. economy. On the employment front, just very quickly, it's not fantastic. It's good. We're adding, on average, over the last 3 or 4 years, about 150,000 jobs. That probably needs to be 500 or 600 to have a normal or a more normal, robust recovery. We're not there. We're not going there. This is going to be a steady Eddie, plod out of the mud recovery. I know you all have heard this many times, but there are too many overhangs just to jump out. And one of those overhangs is the housing market. Good news on the housing market. We're 5 years into this mess, and it was a heck of a mess. And we're probably 75 to 80% of the way through the inventory. And the good news is, historically, housing has been the sector that has led our economy out of recessions. And it clearly wasn't there. It was the problem. Well, we're coming out of the recession and we're growing, and housing is on its way. It's on the back end of recovery, and if we can get that engine to firing, that would be a very positive thing. So as far as corporations are concerned, let's see, I think very interesting. I don't know if everybody's aware of this, but it's always interesting to give perspective here. Corporations today are sitting on more cash on their balance sheets than ever before in the history of record. And the good news is the pressure is increasing for that cash to be returned to us. It can be done in the form of dividends, buybacks, investments. Obviously, everybody in this room would be happy about that. M&A activity. All of these things are good for people or individuals as shareholders. As far as their earnings, Amazingly, and you may not think it, but companies are earning more money, far right-hand side. Their earnings per share are higher today than they have ever been, ever. And yet we are miserable. We're scared of everything, and prices are going nowhere. This is a bit of a conflict, if you will. So as we sit here today, if we look at the basic alternatives that investors have, let's just look at stocks and bonds. Historically, stocks have outperformed bonds over long periods of time by 2.5 percentage points. So bonds up 5, stocks up 7.5, or bonds up 5.5, stocks up 8. That's history. Based on where we are today, with fixed income prices so high, interest rates so low, and with equity earnings so high, prices flat, we're in an environment where we would suggest fundamentally as you look forward that there's a potential that equities outperform bonds for the next 10 years by double that, by 5.1%. But that's good news. The bad news is sometimes investors lead with their emotions and not with fundamentals. We've been here before. Just think back, or you don't have to think back, I'll show it to you. Business Week magazine entitled The Death of Equities in 1979. This title of this magazine could have been yesterday. In fact, that's what we're hearing. I know that they recycle these things. And they're recycling it again, and I will say that media outlets have destroyed more wealth than any other source that I can think of ever. It's really spectacular. During the time that was being published, a couple of years later, we actually held a conference in New York, an investors conference, and we actually had done some research. The Dow Jones at that time was at about 1,300. Our research concluded that over the next 5 to 10 years that the Dow could go to 2,000. And the room fell apart with laughter. Equities are gone. Well, I can tell you an interesting story about that. There was something we were wrong about in that article, and that was it was going to take 10 years to get there. It took 3.5. And I'll tell you another story. 60 days ago, we published the same type of research, not based on the same fundamentals. The title of that research, and I don't have it with me today, happy to get it in your hands, is Dow 20,000. Eye-popping. Wall Street Journal called it, New York Times called it, Forbes called it, Business Week, it went all over the world. This is the craziest thing people have ever seen. Although if you look at the numbers on the Dow 20,000 and how you get there, if you go from 13,000 to 20,000 and you do it in 10 years, it's a 4.5% return. That's not crazy. In 5 years, it's a 9%, a 9%-ish return. That's not crazy. You can get there from a fundamental standpoint, which I just made. You can also get there from a historical standpoint. I'll cover this very quickly. I went back to 1900, and I said, before 2008, how many periods of time were there where equities underperformed bonds, and by how much? And there were 11 such periods. Most of them were in the Great Depression or during the height of the stagflation environment of the 70s. So on the left-hand side of the slide that's going up and down and up and down, you'll see that equities underperformed bonds for that 10-year period by 1.6% annualized. So across the page, those are the periods of time. Example, 1923 through 32. Ending in 32, stocks underperformed by 1.6%, that 10-year period. What did they do the next 10-year period? Well, I have good news on that front. The next 10-year period was not only better, it was wildly better than the previous 10-year period. The average outperformance of stocks relative to bonds that next 10-year rolling period of time was 5.8%, with some periods that were much, much greater than that. So from a historical standpoint, you can make the case the next 10 years will be a whole lot better than the last, and it's pretty easy today with interest rates at 1.5% and stock expected returns pretty significantly higher than that. Here's the problem. Individuals are hardwired to do the wrong thing at the wrong time. And we're doing it again. So on my slide, I've gone back about 15 years, showing the technology boom on the left-hand side as illustrated by, oh, look, it's Business Week. Boom. This was the technology boom. And at the peak, the quarter of the peak of the stock market, $142 billion went into stocks in one quarter at the top, just in time for the market to go down 37%. And oh, it's time for me to get out and sell $72 billion in the bottom, at the bottom, in time for it to go up 100%, in time for the crisis that we just had, which was a disaster. And at the bottom, in the worst quarter, they sold $109 billion in equities, and they did it again In the third quarter of 2011, another $75 billion. This is not out of the markets. This is out of stocks. And guess what? After the last $75 billion went out, the market's up 32% through yesterday. It's terribly unfortunate. I promise I'm going to conclude my remarks, but it's terribly unfortunate that we so consistently look at our statements and say, I'm losing money, I want out. It's so consistent that when markets go up, I feel good. When markets go down, I feel bad. When is the last time you went to the Chevrolet dealership, went to the Suburban guy and said, I'd like to buy the Suburban? He said $55,000. You said, no. When it's $65, call me. Really? Really? I think the real answer is if it went from 65, I'll buy it at 50. Call me when it's on sale. Not in our markets. When the markets are on sale, people run for the doors. And that has been very, very destructive to their wealth. One last study. Dalbar did this. It's the most recent numbers that we have, 1991 through 2010. The S&P 500 was up, including 08 and 09, 9.1% annualized all the way through that period of time. Now, what they were able to do is actually track an individual investors and their movements within that market. And how did they do? And the answer is a very unfortunate. The average investor earned 3.8 while the market was up 9.1, and they were in stocks. They were buying high, selling low, buying high, selling low. It is wildly destructive to wealth. They didn't even outperform inflation. Let me sum up. What can I say? 3 points. Number one, be patient. Move your investment time horizon from 6 days or 6 months. Move it out to where it belongs, 5 years, 6 years, 10 years. This is not a call for equities to go to the moon tomorrow or next year. We may go down 15% this year. We may go down 20% next year. But when we look back at the end of 5 years and 10 years, we're going to say, I wish I had had exposure to equities. And let me be clear what that means. It doesn't mean jump in. It means be at your long-term allocation for stocks and bonds. Don't go over. You don't need to. But everybody's under. Nobody's in. And again, expect volatility, extend your time horizon, and be diversified. It works, and let me hand over the podium. Thank you very much.